Welcome to today's deep dive on the HSA contribution trap and how mid-year coverage changes can trigger avoidable tax penalties. First, I'll outline the problem, then we'll calculate the true limit with the Pro-Rata Rule, and finally we'll show you how to fix mistakes safely. Stay with me through the end for a quick recap and practical checklist. Here is our roadmap. First, we will discuss why HSAs are powerful yet tricky. Next, we will explain the Pro-Rata Rule with simple math. Then we will work through real examples. After that, we will cover the 6% excise tax on excess contributions. Then we will show how to fix an excess using a formal return of excess contribution. Afterwards, we will compare incorrect actions with correct ones. Finally, we will end with quizzes and key takeaways. HSAs provide three distinct tax advantages. Contributions reduce taxable income, earnings grow tax-deferred, and qualified medical withdrawals are tax-free. However, eligibility depends on having a qualifying high-deductible health plan. If you start or stop HDHP coverage mid-year, your annual contribution limit is not the full annual number. Instead, you must prorate based on the number of months you were eligible on the first day of each month. Misunderstanding this can lead to excess contributions and recurring penalties. First, let us set the foundation. You only count a month toward your HSA limit if you were eligible on the first day of that month. Eligibility requires enrollment in a qualifying high-deductible health plan. Second, limits are different for self-only coverage versus family coverage. For 2025, the self-only limit is $4,300, and the family limit is $8,550. If you are 55 or older, you can also contribute a $1,000 catch-up amount, prorated separately by eligibility months. Third, if your coverage starts mid-month or ends mid-year, use a prorated limit rather than the full annual number. Now let us apply the Pro-Rata Rule. Your maximum contribution equals the annual limit divided by 12, multiplied by the number of months you were eligible on the first day of the month. If you are age 55 or older, the catch-up amount is also prorated using the same month count. For example, with family coverage and only 3 eligible months, your cap is $8,550 divided by 12 times 3, which equals $2,137.50. Round to the nearest dollar if your custodian requires it. Be sure to coordinate between payroll contributions and any direct contributions so the combined total stays within your calculated cap. This diagram shows the decision path. First, confirm whether you had HDHP coverage on the first day of a given month. If yes, that month is counted. If no, that month is skipped. After evaluating all months, compute the base maximum as the annual limit divided by 12 times the counted months. If you are age 55 or older, add the prorated catch-up using the same month count. The process ends with your final HSA maximum for the year. If your coverage type changed from self-only to family, or vice versa, you should segment the months by type and compute separate prorated amounts before summing them. Next, here is a clear step-by-step method. First, list each month and mark whether you were eligible on the first day. Second, label the coverage type for that month as self-only or family. Third, reference the annual limits for the year and the catch-up amount if applicable. Fourth, compute the prorated amount for each coverage type using annual limit divided by 12 times the count of eligible months of that type. Fifth, if you are age 55 or older, compute the prorated catch-up using the same month count and add it. Sixth, total all contributions from payroll and from any direct deposits. Seventh, if the sum exceeds your calculated maximum, stop further contributions and begin the correction process. Let us anchor this with numbers using 2025 limits. With 12 eligible months, self-only allows $4,300 and family allows $8,550. With 9 eligible months, self-only allows $3,225 and family allows $6,412.50. With 3 eligible months, self-only allows $1,075 and family allows $2,137.50. If you are 55 or older, you would add a prorated catch-up of $1,000 divided by 12 times the number of eligible months. Now consider common mid-year scenarios. If you started HDHP coverage on January 15th, you were not eligible on January 1st, so January does not count. Your first counted month would be February. If you ended HDHP coverage on August 31st, August does count because you were covered on the first day of that month. If you changed from self-only to family in May, compute prorated amounts for each segment and then add them together. Always coordinate between payroll-based contributions and any personal deposits to ensure the combined total does not exceed your prorated limit. Quiz time. You began HDHP coverage on January 15th and kept it through August 31st with no coverage after. How many months count toward your HSA limit? Option A, 6 months. Option B, 7 months. Option C, 8 months. Option D, 9 months. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 7 months. January does not count because you were not covered on the first day. February, March, April, May, June, July, and August each count because coverage existed on the first day of those months. Moving on, let us cover penalties. If you contribute more than your calculated prorated limit, the excess is subject to a 6% excise tax. This tax recurs every year that the excess remains in the account, creating a compounding drag on returns. Many excesses happen when coverage ends mid-year, and people forget to prorate the annual limit. Next, here is the safe fix. Contact your HSA custodian and request a formal return of excess contribution. Do not attempt a normal withdrawal or a direct transfer. The custodian is responsible for calculating the net income attributable to the excess, whether positive or negative. The excess principal itself is not taxed upon return, but any earnings attributable to that excess are taxable income for the year they relate to. After the return is processed, correct your payroll elections and automatic transfers to prevent a repeat. This timeline highlights the sequence. First, an excess contribution occurs. Second, you detect the issue by calculating your prorated limit or reviewing year-to-date contributions. Third, you contact your HSA custodian. Fourth, the custodian calculates the net income attributable to the excess. Fifth, the custodian returns the excess and any associated earnings or losses. Sixth, you report any taxable earnings as income for the correct year. Finally, you resume contributions at the properly adjusted level. Let us compare actions. On the do not side, you should not roll the excess directly to an IRA. That is not a qualifying rollover and will be treated as a taxable distribution with potential penalties. You should not attempt a do-it-yourself transfer or a standard withdrawal because it will not fix the excess and can create additional reporting problems. You also should not ignore the situation. On the correct side, you should request a formal return of excess contribution. Allow the custodian to compute net income attributable and process the return. Then update your payroll elections and halt further deposits until you are certain you are within your prorated limit. Second quiz. You discover you exceeded your prorated HSA limit by $800. What should you do next? Option A, transfer $800 directly to a traditional IRA. Option B, withdraw $800 yourself and keep records. Option C, request a formal return of excess contribution from the HSA custodian. Option D, do nothing and let the excess roll to next year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to request a formal return of excess contribution from the HSA custodian. Only this process properly removes the excess and handles the required earnings attribution. A do-it-yourself withdrawal or an IRA transfer will not resolve the excess and can cause taxes and penalties. Doing nothing allows the 6% excise tax to recur annually. Here are the key takeaways. First, only count a month if you were eligible on the first day. Second, calculate your cap as annual limit divided by 12 times eligible months and add prorated catch-up if applicable. Third, coordinate payroll and personal contributions to avoid overfunding. Fourth, the safe remedy for an excess is a formal return of excess contribution. Fifth, excess amounts incur a 6% excise tax for every year the excess remains uncorrected. To summarize, HSAs provide strong tax advantages, but the timing of eligibility controls your actual limit. Mid-year changes require precise prorating. Excess contributions are costly due to recurring excise taxes, but they are fixable when you request a formal return of excess contribution. When in doubt, double-check your counted months and contact your custodian for assistance. Disclaimer: this content is for educational purposes only and does not constitute tax, legal, or financial advice. Consult a qualified professional who can review your specific situation, plan documents, payroll systems, and the current IRS rules before taking action. Rules can change, and special cases such as the last month rule or qualified HSA funding distributions may apply. Thank you for watching. If you found this helpful, please like the video, share it with someone who might need it, and subscribe for more practical guides. Leave your questions or scenarios in the comments, and we may cover them in a future episode.